Hello everyone. Under this video, you're going to see how to calculate a depreciation under Section 32 of the IT Act under the head profit and gains of business or profession. So, if you look at the slide, we can say that the method of computing depreciation as per Income Tax Act is entirely different from the accountancy method. And for the purpose of income tax, the assets are categorized into block of assets. So block of assets means a group of assets of same nature in respect of which same rate of depreciation is charged, or in other words, to fall in the same block, the following two conditions are to be satisfied. The assets must be of the same nature, that is either tangible assets or intangible assets, and the rate of depreciation on such assets must be the same. So it means that assets will be classified into tangible and intangible assets. So these assets or these blocks of assets will have the same rate of depreciation. Now the next slide says or shows how to compute depreciation. So depreciation shall be calculated as per the following formula. So the rate of depreciation as per the block into the written down value of the block of assets as on last day of the previous year. Then how to calculate the written down value? So written down value under section 43.6 will be computed as follows. So written down, first of all, you have to take the written down value of block of assets at the beginning of the relevant previous year. Then you have to add the actual cost of assets belonging to that block acquired during that particular previous year. Then you have to less the money receivable on assets sold, discarded, demolished, or destroyed during previous years, including scrap value. Then after adding and subtracting the actual cost and the money receivable, will get the written down value of the block of assets as on the last day relevant of the previous year. Now let us look at this particular illustration from the textbook. It says calculate depreciation which can be debited to profit and loss account for the year ending on 31st/3/2020. So they have given you factory building, they have given you number 2 residential house, number 3 is furniture and fittings, number 4 is plant machinery, then 4B is air compressor, 4C is solar power generator, and number 5 is cost of 2 calculator purchase at the rate of 4% per annum. So factory building, uh, the rate of depreciation is 10%. Then for residential house, the rate of depreciation is 5%. Then for furniture and fittings, the rate of depreciation is 10%. Then for plant and machinery, it's 15%. Then for air compressor, it's 15%. Then for solar power generator, it's 40%. Then for calculator, the rate of the rate of depreciation is 15%. And the note has been given. It says that plant and machinery and air compressor were acquired and put into use in November 2019. But for solar generator, it was put to use in June 2019. Then you have to, and the calculator were acquired on 14/10/2019. So now let us see how to calculate depreciation under this case. Now for the first one, that is for building. So for building, it falls under 10% block. So first of all, I have to take the written down value at the beginning of the current previous year. So if you look at the problem, the written down value on 1/4/2019 for factory building, it is 3,50,000. Then you have to add the actual cost of new assets. So the actual cost of new assets, that is the additions during the year, it is 1 lakh. So you add the actual cost of new assets, that is 1 lakh. Then you have to less the money realized. So you can look from the question itself under factory building, the money realized on assets destroyed is 60,000. So you add the actual cost of new assets and you less the money realized, you have the written down value at the end of the current previous year, that is 3,09,000, and the rate of depreciation is 10%, so it will be 39,000. Then for the second one, that is residential building, this is 5% block. So again, here also the same thing, you have to take the written down value at the beginning of the current previous year, that is 10 lakh. Then you have to add the addition during the year, that is rupees 5 lakhs, but there's no there's no money realized on assets destroyed. So in that case, the residential building will be only rupees 15 lakhs after adding the cost of new assets. Then the rate of depreciation is 5%. So 5% of 15 lakhs will get 75,000. And now let us look at the next one. Then regarding furniture, again the same thing, we have to take the written down value on 1/4/2019, that is at the beginning of the current previous year, it is 15,000. Then you add the additions during the year, that's 5,000. So there's no money realized on the assets which are being destroyed, so there's nothing in it. So in that case, the written down value on 31st/3/2020, that is at the end of the current previous year, is 20,000, and depreciation rate is 10%. So 10% of 20,000 is 2,000. Now the next one is the plant and machinery. Now for plant and machinery, written down value as on 1/4/2019, if you look from here, it is 20 lakhs 40,000. Then there has been an addition during the year for plant and machinery, that is 4 lakhs 50, 6 lakhs 50,000. Then also we have the air compressor, which falls under plant machinery, then under the same rate of depreciation, so 32,000. Then we also have the cost of two calculators. This also falls under the plant and machinery block, that is the rate is 15%. So you can see here that the cost of new assets acquired, first of all, will be the cost of plant machinery acquired, that is 6 lakhs 50,000. Then the calculators acquired on 14/10/2019, that is 8,000. Then the air compressor, which has been acquired for rupees 32,000. So after adding the actual cost of new assets acquired under plant machinery 15% block, we have 27,000 27 lakhs 30,000. Then you have to less the money realized on assets destroyed. So for plant machinery, you have 2 lakhs 70,000. So after deducting 2 lakhs 70,000, you'll get the written down value as on 31st 2020 is 24,600. So listen here carefully. Under plant and machinery block, there are 3 new assets which has been acquired. So the first one is plant and machinery for rupees 6 lakhs 50,000, then calculator for rupees 8,000, and air compressor for rupees 32,000. Now if you look at the problem, okay, it says that plant and machinery and air compressor were acquired and put into use in November 2019. So remember, it has been put into use in November 2019, and the calculators were acquired on 14/10/2019. So the date in which the calculators are being put into use is not given. So it will be assumed that the calculator were acquired on 14/10/2019 and put into use itself on 14/10/2019. So now here, for any new assets which has been acquired, if the assets are being put into use for less than 180 days, then depreciation will be charged only for half year. Now look from this particular point. It says that in case of newly acquired assets during the current previous year, that is during previous year 2019-20, full depreciation is allowed if assets is installed and used for 180 or more than 180 days, and half years depreciation is allowed if installed and used for less than 180 days. So in this case, in the case of plant and machinery, in case of calculators, and in case of compressor, they have been used or put into use on November 2019, and also calculator will be assumed that it has been put into use on the day of acquisition, that is 14/10/2019. So for plant and machinery and for air compressor, from November 2019 till 31st March 2020, the period does not exceed 180 days, and similarly for calculators. So it means that the assets has been put into use for less than 180 days. So if assets has been put into use for less than 180 days, only half year depreciation will be charged. So in that case, if you look here on new assets used for less than 180 days, the total is 6 lakhs 90,000. That is for the new plant originally acquired for 6 lakhs 50,000. Then plus the calculator 8,000. Then plus the air compressor 32,000. So the total is 6 lakh 90,000. The rate of depreciation is 15%. Then you have to take only half years. So into half of it, so you'll get 51,750. Then for the old plant and machinery, okay, so there are 2 ways of calculating. So in this case, from the textbook, it says on balance on the balance written down value, the total written down value is 24 lakh 60,000. Then you minus 6 lakhs 90,000 on the new assets which has been acquired under plant and machinery block. Then into 15%, you'll get 2 lakh 65,500. Or you can do in this way also. You can take the old plant machinery, that is the value is 20 lakhs 40,000, then minus the amount which has been realized due to the destroyed by fire, that is 2 lakh 70,000. You'll get the same amount into 15%, you'll get 2 lakh 65,500. Then now let us talk about additional depreciation. Now here, if you look at additional depreciation under section 32(1)(2)(a) of the Income Tax Act, it says that with effect from assessment year 2006-2007, an additional depreciation at the rate of 20% on actual cost is allowed in addition to normal depreciation on the new plant and machinery which is acquired or installed on or after 1/4/2005, provided all the conditions are satisfied. So any new plant and machinery acquired before 1/4/2005 but installed on or after 1/4/2005, additional depreciation is not available. So to make it simple, it means that any new plant machinery which is acquired after the assessment year 2006-2007 will be allowed an additional depreciation at the rate of 20%, in addition to the normal depreciation. But to claim the additional depreciation at the rate of 20% of the actual cost, the condition of use for minimum 180 days during the relevant previous year shall be applicable for this depreciation also. So if used for less than 180 days in the previous year in which is required, then additional depreciation shall also be allowed at the rate of 10% only for half year, and the remaining 10% of the total depreciation shall be allowed in the next previous year. So it means that if the new plant and machinery has been acquired during the year after the assessment year 2006-2007, then additional depreciation will be allowed in addition to the normal depreciation. Then the rate of additional depreciation is 20%. But if the asset has been put into use for less than 180 days, the depreciation will be allowed only for half year. So half of 20% will be 10%, and the another half will be allowed in the next previous year. So that is why if you see here, the additional depreciation has been given, only for those assets which has been newly acquired and which has been used for less than 180 days. So in this case, it has been taken only for the new plant and machinery and for the air compressor, that is 6,50,000 and 32,000. So you have to remember, or you have to keep this in mind. We also have calculator, but remember these calculators, even though they fall under the same block of assets of plant and machinery under the 15 block, but remember, for any office appliances, additional depreciation is not allowed. So that's why additional depreciation is being allowed, or additional depreciation is being allowed only on the new plant and machinery and the air compressor. So number 5 is plant and machinery, 40% block. Now this is the solar power generator. You can see there, there's no old balance, only the addition during the year, that is 1,50,000, and the rate of depreciation is 40%. So now if you look at the solution, it says that the cost of solar generator is 1,50,000, then normal depreciation at the rate of 40%, that is 60,000, and since it is newly acquired and it has been used for more than 180 days, because if you look again, let us go back to the problem. It says that solar generator was put into use in June 2019. So the period from June 2019 to 31st March 2020, it is more than 180 days. So it means that it has been put into use for more than 180 days. So it has been put into use for more than 180 days. Additional depreciation will be allowed at full rate. So that's why additional depreciation at the rate of 20% of the cost, the actual cost of the asset, that's 1,50,000. So we'll have here 30,000. So total depreciation for this block, that is solar generator, is 90,000. So if you add the last column, you'll find a total depreciation of 5,91,450. So here it has been given as note, additional depreciation is not allowed on calculators because these are office appliances. So additional depreciation are not allowed on office appliances.